Welcome to Early Age Club, where we break down one microcap or SME stock a day using a simple structured 20 factor scorecard. Microcap investing can be rewarding, but it's also full of traps. Our goal with this series is to help every retail investor avoid the common mistakes and develop a more thoughtful approach when it comes to investing. If you're new here, I recommend checking out the explainer video on how to use the scorecard. Try scoring the company yourself as it will give you real hands-on clarity. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. This company analysis and discussion are part of our internal conversation as we review companies from our ongoing 500 plus microcaps and small cap stocks. We are sharing this to retail investors can build a structured framework when it comes to microcap investing. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
Vision Infra Equipment Solutions is basically a equipment and machinery lending and refurbishing company. So it is in the business of leasing, renting, refurbishing, and selling road construction equipments and other type of construction machinery. It manages work contracts, project crushing, soil stabilization, recycling, milling, and paving. Its business model includes timely based rentals, which is a recurring revenue, and output based rentals, which is a performance based growth objective. And trading and refurbishment of construction and infrastructure equipments is also another part of their business, a majority portion of which they export abroad. Their revenue breakup is as follows. Refurbishment business contributed 50% of the revenue, and rental business contributed around the remaining 50%. Now, the rental business, they're constantly scaling upwards, and the refurbishment business is almost stagnant. So, their primary focus is on increasing the rental income. They came up with their IPO in 2024. It was a fresh issue of 106.21 crores gross, out of which they spent 47 crores on capex of additional equipments. Working capital requirements were of 37 crore, and they intended to use the remaining for general corporate purposes. So pre-IPO in July 2024, they also raised 11.5 crore in private placement for the same general corporate purposes. So they and the management mentioned that they reduced the IPO issue amount by this private placement amount to balance off. So I gave it a 5 here. Their chairman and managing director is Mr. Sachin Vinod Gandhi, and it's a closely held, family held company. Gandhi family holds around 70.24% of the company. They don't have any negative track record, so I give it them a 5. Now, RPTs are a big risk in this organization. Partners have given a lot of loans to the company in multiple years and have even taken interest against those loans. A strange thing which we noticed was that partners transferred their capital to unsecured loans worth 33 crores. Now, if the company is growing, why would the partner convert their capital into unsecured loans? Doesn't seem nice. Also, loan transactions with Equipment Hub, which is an entity controlled or jointly controlled by directors, they have loan transactions with around 30 to 60 crores with them, both given and taken. Same for global infra equipments, they have a heavy amount of loan transactions with them, which is also a director controlled entity. So a lot of RPT, so I gave it them a 0 here. Also, number of directors were six, out of which two were independent, so 33% independent directors, and three family members on board, so 50% family on board. So I had to give them a 0. There is limited board independence. Also, they are holding 70% of the company, so high promoter control. Their salary hasn't been that high. Mainly, they're gaining a lot of money from the interest which on the loan they have given to the company. So that's also a source of their income. I did not add them here, but yeah, that's something to be noted. Actually, I could have imputed that by giving the percentage, but they have taken and given loans in successive years. This year's interest can be the last 2 years loan amount combined. So we cannot figure out exactly how much percentage at which they have lent. They don't have an annual report precisely. They basically upload their financial statements by clicking its pictures. The maximum information which I could fetch was from their prospectus. So all this salary information and RPT information are mostly from the prospectus. It listed in September 2024. So there hasn't been any key person resignations, and there hasn't been any change in statutory auditor in the last 3 years. So I gave them a 5 in both these parameters. Auditor opinion has been unmodified over the years. They haven't availed for any credit opinion. There hasn't been any regulatory issues relating to them also. So I gave them a 5 here also. They do press releases and presentations, but they don't do con calls, and they update their results half yearly. Talking about client concentration, so these are the sectors they are serving, from road and highways to metro. They are serving all the infrastructure related sectors. They have many popular companies like Ashok Leland, Atlas Corp, Komatsu, Volvo as their OEM partners. And some of their marquee customers include Larsen and Toubro, Tata Projects, IRB Infra. So basically, what happens is that when this company procure very large scale infrastructure projects from the government, they outsource it to smaller entities. So because of this outsourcing, entities like Vision, they generate their revenue. So that's why their growth is very directly linked with government expenditure on infrastructure. So they have a very good geographical network and expansion, pan-India operations with presence across 26 states and 200 plus satisfied customers. Top one customers contributed around 19% of the revenue in 2025, which is a massive improvement from 2023, which in which the top customer was contributing 68%. Also, top 10 customers contribution have also reduced over the years to just 62% in 2025. 62% still seems a bit high, so we gave them a 3. Also, they have also mentioned in their RHP that they have client concentration risk associated with them. Now, right now, they're planning to expand their footprint into international markets with 80% of refurbished machinery exported in fiscal year 25. So the refurbishment part is primarily concentrated into exports. And they haven't entered into any long-term agreements with any of these top 10 customers as of now. Revenue growth was nice, it was 33%, but receivable growth was much higher, and receivable as a percentage of revenue was 33.3%, which seems a bit high. Operating cash flow as a percentage of EBITDA was 31%, which is very low, and this happened because of very high receivables. So I gave them a 0 here. Inventory turnover ratio was 5. Inventory days were not very high, but DSO was very high. So they face a lot of trouble collecting payments. So that's why I give them a 3 here. In cash conversion cycle, it sums up to 113, which is moderately high. So I gave them a 3 here. CapEx as a percentage of revenue is 33%, which is high, meaning they're very high capital intensive. And they have a management guidance of 100 crore CapEx in fiscal year 26. And their fixed asset turnover is 2, and their asset turnover improved a bit, but it's still 1 because of high receivables. The return on invested capital is good, so I give them a 5 here. And debt to equity ratio is super high, it's 1.7. They might face cash based insolvency issues, and their interest coverage is just 2.8. So if they lose any of their major customers, it would take a big hit on their business. So I give them a 0 here. Quick ratio and current ratio seems good, so I give them a 5 here. Return on equity, return on capital employed are too good to be true, but return on asset has been low due to their capital intensive nature, so I give them a 5 here. Revenue growth, PAT growth, and all other growth margins, we don't have year on year figures, but this year they grew really well, so I gave them a 5 in this parameter. Now, moving forward to their business aspect, their time-based pricing model in which they rent their equipments and machinery on timely basis. It includes a large fleet of all this machinery used in road and infrastructure construction. Their output-based pricing model is highly dependent on how many kilometers of road is laid using their machinery. So it grows with increase in infrastructure investments. Actually, three models. One is time-based renting, one is output-based renting, and one is refurbishment. They are saying that the recurring revenue part is highly growing, so they're focused on the rental business. And the refurbishment business is aligned with the sustainability goals. So they have participated in all these marquee projects, starting from airports to defense projects, railways, and smart city projects. Coming down to the key takeaways, they have a 240 crore order book. Industry tailwinds include National Infrastructure Pipeline, National Highway Authority of India, and Union Budget's infra targets. And they're planning to working towards scaling their comprehensive margin in the rental business, which I mentioned just now. And they also have a plan to strategically expand into concrete pavers. Now, these concrete pavers are far more sustainable, efficient, and they are also low cost. So, if they pull this off, this might add a lot of revenue to their company. They're targeting in this concrete pavers thing, they are targeting projects under Maharashtra State Industrial Development Corporation, Maharashtra State Road Development Corporation, NHAI, and these there are project opportunities worth 86,021 crore in Maharashtra and Pune region itself, and their existing order book in this region is around 27.15 crores. So they flaunt it as one of their merits that they have a high rental capacity utilization and they're profitable and they scale their operations efficiently during the COVID-19 period. Management guidance is a revenue growth of 20% plus, supported by robust order execution with EBITDA margins expected to remain strong at 27 plus percent. Some of the risks they face is that like this is one of their pros that they reduce the depreciation and redundancy risk for their customers, but they are assuming the risk themselves. So their machinery gets redundant and depreciated over time. So they have to account for that. So they need constant orders to keep their machinery in use so that they can manage for the depreciation and replace machinery. Also, their business is highly capital intensive, as we noticed, and it relies heavily on government spending. Also, significant percentage of the revenue comes from a few clients, which poses concentration risk, and they are also limited on a dependent on a limited number of suppliers for their highly efficient equipments. So that is also a risk. So their entire supply chain is entangled in a lot of risk. So the company scored average score of 73.
Before we deep dive, quick note, we are opening Early Edge Club to a small founding cohort of 15 to 20 serious microcap investors. We are building a research first community where we break down businesses together. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon.
So let's just run the smart analyzer and see. So basically, this is the problem, the debt of
Yeah, they're
279
highly leveraged,
with the market,
1.7 times.
yeah, with the market cap of 417. It's been sideways almost, but they've grown really well. Any idea on the future growth?
Management said that they are expected to grow at 20% plus revenue growth, and they are expected to
Okay.
expand margins in their rental business, which they're scaling very
Mm,
fast. EBITDA margins are
mm.
expected to remain strong at 27% plus. So they have good growth
Because,
guidance.
yeah, because we have only 2 years of data, this tool is not taking the best case and the worst case scenario.
Yeah, it needs
Yeah.
average median data.
Yeah, 3 to 4 years is minimum, I think. It take. Yeah, this data is not captured, but then the gross margin is decent. Okay, cash flow is 40, and what is the profit before tax? 48, which is almost equal, which is still good. So if, as in microcap investor, if you need at least minimum 20% return, the company should go grow at 5%. I think this 5% is capturing because of the low P ratio. It's only 12.2.
Yeah, it
So the
has to take into
valuations are
account
very,
the risk part.
yeah, the valuations are supportive, which is good. So valuations are supportive, but then the other risks you have highlighted. One of the main risks being the promoter governance is
If
something
the
which we
if the
need to
promoter
watch.
governance part was decent, still it could have been a risk-taking opportunity because no, I don't think the
Hmm.
infrastructure investments are going to reduce in the upcoming years. And the company has a
Hmm.
record of scaling their operations even in times of adversities like COVID-19. This company
Hmm.
might play out
Okay.
well and reduce debt over time.
Yeah. They have 250 crores order book.
Yeah,
Uh, Market cap is 400 crores, which is good.
they have around 24 crores from the new concrete pavers business also.
What was the receivables days?
147 crores. So almost
Uh,
like half of the revenue.
yeah, that is huge.
But
They don't have
but I don't
pricing
think their
power.
clients are likely to default because they're all MNCs.
True, but then your half of your revenue are stuck as receivables. The faster you collect, the more you can grow. So most of them are under 6 months, which is still okay. We don't have data for 2025, but yeah, there's a huge jump.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20 factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye bye.